Hi, good morning. We want to derivatives and we started off on options. So let's continue from where we stopped. Right, so let's try the next example. You asked to calculate the value of the following call options. Let's say you're long, strike price 100, premium 4, stock price 90. So let's draw the payoff diagram of a call option. Now, when you come across questions on options, just make sure you start off with the payoff diagram. Right? Always use the diagram, then it's easy. Right? Easy to understand and tackle. Long call option. Strike price 100. Premium 4. And the stock price is 90. So this option is in the money. Is it? Is it in the money, out of the money? It is out of the money. This option will not get exercised. Okay. It's a call option. So at 90, the profit will be a $4 loss. You make a $4 loss at 90. Yes, you can see the ink. Right, I'll draw it again. Let's do the payoff diagram. That's even worse. Strike price of 100, premium 4, and the market is at 90. And so this is out of the money. You will end up with a profit of -4. That is a $4 loss. Next one, you are short. Strike price 100, premium 4. What happens when you are short? Market is 110. What happens when this is 110? So if you're long, your profit would be strike minus market minus the premium. Sorry, it's a call option. It is the market minus strike. Market 110, strike is 100, minus a premium of 4. That is if you are long, but you are short. Profit will be -6 because it is the long's profit will be the short's loss. Right? So that at 110, the long will make a profit of 6, and the short will make therefore a loss of 6. Right? Yeah. Okay, so let's move on to the next question. A Sri Lankan exporter will receive 1 million yen in 3 months. He expects the current yen rupee of 84 to increase to 90. What is the protection he can get from an option strategy if his view does not materialize and the yen rupee increases? Right, so Sri Lankan exporter is expected to receive 1 million yen in 3 months. Now, since he's an exporter, he will receive yen, which he needs to convert into rupees. Right. So the higher the yen rupee rate, the better. He will benefit because he gets more rupees when the rate increases. The yen rupee rate is currently 84. It is expected to go up to 90. Right. So that is going to be in his favor. If he expects the rupee to weaken and the yen to strengthen, that means he will end up getting more rupees. So it is in his favor. Now, why does he need any protection? Because there is no guarantee that the yen rupee rate will increase. It can increase, it can go down, but there is no guarantee. So what if by any chance the yen rate goes to 75 from 84? Then he will lose. Right, so he needs a strategy which will help him hedge against the loss. So what is the protection he can get from an option strategy if his view does not materialize and the yen rupee increases? What he can do is, he is getting yen which he needs to sell. And so he needs to buy an option which gives him the right to sell yen. Yeah. So what he can do is he can buy a yen rupee put option. A put option on the yen. Okay. Now when you buy options, you need to buy an option which is out of the money. So in this case, it is a put option. Remember the put option? We have diagram of the put option. He needs to go long a put option. Strike price of maybe 75. Market is currently 84. So he needs to buy an out of the money put option. The strike price below the market. He needs to go long a put option. On yen rupee at the strike price of 75. If he does that, he will be hedged. Right. Next question. Now the option premium is equal to the intrinsic value plus time value. That is how you calculate the option premium, intrinsic value plus time value. Intrinsic value for a call option, if you all can remember, is the market price minus the strike price. For a put option, it is strike price minus market price. What you need to remember is intrinsic value will never be negative, which we discussed last week. An option is usually never worth less than what an option holder can receive if the option is exercised. Right? So it can be never worth less than what you receive when it is exercised. Intrinsic value is the difference between the price of the underlying and the strike price of the option. It's the in the money portion of the option. Time value is the value that is attached to an option due to its time period, to maturity, to expiry. Now, the longer the time period, the higher the value of the option. Right? And the time value as it approaches the exercise date or the expiry date reaches 0. It's called time decay. Let's try this question. It says the following prices were reported on 2014 June on December 2014 call options on the shares of ABC. You have been given that the price of a call option is 35.75, strike price is 66, spot price is given as 80.75. Just to calculate intrinsic value and time value. Also, is the option in the money? What do you think? Call option strike price 66, price of this option is 35.75, and the market is at 80.75. You want to calculate the intrinsic value and the time value of this option. So the premium, what you know is that the premium is equal to intrinsic value plus time value. Right. Now the intrinsic value for a call option is the market minus strike. The market is 80.75 minus the strike price of 66. That is $14.75. That's your intrinsic value. Right. So you can go back to this equation. The premium is 35.75 equals intrinsic value of 14.75 plus time value. So the time value of this option is 35.75 minus 14.75. You will end up with $21. And part B of the question says, is the option in the money? Is this option in the money, out of the money? It is in the money because the intrinsic value is more than 0. Right? If the intrinsic value is more than 0, it is in the money. Obviously, if you look at the diagram also, the market is above the strike for a call option, so it has to be in the money. Yeah, very good. Now, option price sensitivity. You all could recall, we did sometime back a measurement called duration. Right? Duration measures the interest rate sensitivity of a bond. So likewise, the price of an option also is sensitive to various factors. Right? So let's see what they are. First one is called delta. That is the change in option price, which is the premium, change in premium divided by the change in the underlying price. Then you have gamma, which is change in premium divided by change in, sorry, it's a change in delta divided by the change in the underlying price. Next one is theta, which is the change in premium divided by the change in underlying, but change in time. Then we have vega, which is the change in premium divided by the change in volatility. And rho is the change in premium divided by change in interest rates. So these are all letters of the Greek alphabet. So they are called option Greeks. Easy to remember. The theta and time, both T. Vega, volatility, both V. Rho is R, which is an interest rate. So it's the change in interest rates. Right. So what you need to remember is all of these are the measures the sensitivity of the premium to various factors. Now delta measures the sensitivity of premium to the underlying. Right. Gamma measures the sensitivity of delta to the underlying changes. Right. So that's how it works. Now there are instances where you can combine options. They're called option strategies. Right. So let's see how we can do it. First one is called the straddle. Now in a straddle, you combine a call option and a put option at the same strike price. Right. That's called option. That's called a straddle. Now, if you look closely, you will see that if the market is stable, right now in this case, if the market, for example, is between 35 and 45, right? If the market is within that range, you will lose money. You will lose what you pay as premium, right? You will end up with a loss. But if the market becomes volatile, for example, if it falls below 35 or if it goes above 45, then you will make money. Okay, so the straddle, if you are long straddle, you will make money if the market becomes volatile. But if the market is stable, you will lose money. That is how a straddle works. How it is formed is you need to buy a call option. Now, if you look at this, if you draw at $4, if you draw a line, a dotted line, it will look like a long call option. And at $4, if you draw a dotted line to the other side, it looks like a long put option. So it has, you'll see that you'll understand that a straddle is a combination of long call, long put. Then you have strangle. Similar to straddle, only thing the strike price is not the same for the call and put option. Right? You have two different strike prices. The put option has a lower strike, call option has a higher strike, which means the strangle will cost you less than a straddle, right? Because the call option strike is higher and the put option strike is lower. So the cost will be less than a straddle. Again, you will make money if the market is volatile, but if the market is stable, you will lose money. Spreads. There are a couple of ways of forming a spread. One is called the bull spread, where you benefit if the market goes up, and the bear spread, where you benefit if the market falls. And so the bull spread can be formed by buying a call option at a low strike and selling a call option at a higher strike. So net, you will be paying a premium because you are buying a low strike call and selling a high strike call. That's called a bull spread. Then a bear spread is the opposite. A bear spread is where you buy a high strike put and sell a low strike put. Right? Butterfly spread, you can buy a call option at a low strike, then sell two call options at a higher strike, and buy a third call option at an even higher strike. That's called a butterfly spread. Now, if you look at the butterfly spread diagram, you will see that if the market is stable, you make money. But if the market becomes volatile, you will lose. Right? You will lose the net premium that you pay. Right. So let's move on to some more questions. It says a Japanese importer has to pay $2 million in 3 months. The current dollar-yen rate is 90, and he thinks that the dollar-yen rate will decrease to 85. So what can he do? What do you all think? Any suggestions? Okay, buy a call option. Right, so let's see what has to be done. Now he's a Japanese import. Right, so his domestic currency is yen, and he has to pay $2 million in 3 months. Right, meaning if he has to pay $2 million in 3 months and his domestic currency is the yen, he will have to buy $2 million in 3 months' time. Right. So if he has to buy dollars, he will benefit if the yen strengthens. That means the dollar should weaken. Okay. The dollar is the base currency. If it weakens, means the rate should fall below 90. It's currently 90. He expects it to go to 85, which is in his favor. If it goes to 85, he will benefit. But the risk is if it goes to 100, then he will lose. So how can he hedge? Right. What he has to do is he needs to buy an option which gives him the right to buy dollars, but without an obligation. Right. So an option, basically, which gives him the right to buy dollars. So Gerald, you're right. He has to buy a call option. Now, it's also important that you mention the strike price. So when you buy options, you need to buy an option which is out of the money. In this case, the market is 90. So to be out of the money, the strike price has to be above 90. Now, when you decide on the strike price, right, when you do it practically, you have to decide at what level you're comfortable. Now, if the market goes up, if it goes to 120, for example, and if you are exposed to it, you will lose, right? So internally, you will have to decide maybe amongst the board that your risk tolerance is a certain amount, right? So based on the risk tolerance, you can decide on the strike price. So you can say you're happy with losing maybe 10 yen. And if the rate goes to 100, you're ready to willing to pay a maximum of 100 rupees as the exchange rate for this. 100 rupees will be the maximum exchange rate you're willing to pay. Right? So you can say you need to go long a call option at a strike price of 100. Okay. But only thing, that is not the perfect answer, not good enough. You won't get marks at the exam. Right? So it's very important that you remember, you should not just say you buy a call option. Answer is correct, but you need to complete the answer. Give a complete answer. You need to say you need to buy a call option on dollar yen, right, at a strike price of 100. Long call option on dollar yen at a strike price of 100. That is what you need to say. Next question. A Sri Lankan exporter with dollar receipts in 3 months. Right? He expects to receive dollars in 3 months. The dollar rupee rate is 134.25 and the 3-month forward is 40 cents. What can he do? What do you all think? What can he do? Any ideas? Okay. So let's go through again. Sri Lankan exporter, meaning he gets dollars with 3 months dollar receipts in 3 months. The current spot rate is 134.25. 3-month forward is 40 cents. So what is this 40 cents? It is the swap point, right? If you could recall, the swap point. Swap point is 40 cents. Now, using the spot rate and the swap point, you can find the outright forward rate. Forward rate, spot rate plus the swap point. Spot rate 134.25 plus swap point of 40 cents, which comes to 134.65. This is the 3-month outright forward rate, 134.65. If he thinks that the dollar will trade higher, one thing he can do is he can book a forward rate outright at 134.65. Right. Now, what happens when you book outright forward rate? It's like getting married. There's nothing you can do about it. It's an obligation. Whether you like it or not, you have to go ahead, right? So at 134.65, regardless of what happens in the market, you have to go ahead. By any chance, if the market goes to 140, you will not benefit. Right? But if it comes to 120, then you are well off. So you are committed at 134.65. Whatever happens in the market, you will get 134.65. Right? That's an obligation. The other thing you can do is you can do an option. You can buy a put option. Why? Because you need to buy an option which gives you the right to sell dollars. The option that gives you the right to sell is called a put option. You need to go long put option on the dollar rupee, a strike price of maybe 130 or 120. You need to buy an out of the money put option. Right? Market is 134.25. Out of the money put option might be 130 or 120. You can decide on the strike price based on your risk appetite. But it has to be out of the money because in the money options will be expensive. So you need to recommend an option which is out of the money. So if he goes long put option, long put option on dollar rupee at a strike price of 125, right? Now, if he does this, if the market falls below 125, the bottom rate he will get is 125. So his risk is capped at 125. Worst he will lose. The worst rate he will get is 125. But if the market goes up, he will benefit because he is buying an option. Therefore, he has no obligation, right? He has a right to exercise his option at 125. Okay, so Gerald has a question. Why we should buy out of the money options, right? Now, if you go back to the price of an option, premium is equal to intrinsic value plus time value. Right, intrinsic value plus time value. Now, intrinsic value is a call option. Intrinsic value is the market minus strike. So if you buy an in the money option, then the market will be above the strike. In the money call option, market will be above the strike. Okay, so this will be a positive number. For example, if the market is 160 and your strike is 150, your intrinsic value will be 10. But if you buy an out of the money option, let's say strike price 150, you buy an option, the call option, when the market is 100, right? Strike price 150. Strike price 150, market is 100, then it is out of the money. Okay. If it's out of the money, market is 100, strike price 150. This becomes 0. It doesn't become negative, but it is 0. And so when it's 0, you are left with only the time value. Otherwise, you will be paying a huge amount as premium. The example that we did, like your intrinsic value was $14, something like that, $14.75. If you had bought an out of the money option, you will have an intrinsic value of 0. Then you will only be left with the time value. Right? So you will have to deal only with the time value. You won't have intrinsic value. So to reduce the price of the option, you need to pay 0 intrinsic value. Just make sure that the intrinsic value is 0. Right? Otherwise, there is no point buying an option because anyway you're paying the difference between the strike price and the market. Market minus strike, you will be paying otherwise. So to avoid that, you need to buy out of the money options. I hope it's clear, Jared. Right. Next question. Stock of a company is trading at 100 rupees, and the fund manager sells 110 rupee calls for a 1 rupee premium. Okay. So what happens? What are your thoughts in this case? The share is trading at 100, and the fund manager is selling call options. Selling call options, I repeat, at a strike price of 110. And he receives a premium of 1. So what happens? Current price is 100. Current price is 100, and he has sold call options at a strike price of 110. So if he has sold call options, that means if the market goes above the strike, the buyers of those call options will exercise their right, and they will buy call options. They will buy shares of A at a price of 110. Right? So this fund manager is then forced to sell, is committed to sell rather, shares of A at a price of 110. Meaning if it goes above that, if it goes to 150, the maximum he will get is 110, because he has already agreed to sell at 110. Right? So if the market stays in between, he's okay, he's fine. But if it goes above, he doesn't get the benefit. Right? His gains will be kept at the price of 110, nothing above that. He's not going to collect anything above 110. Maximum he will get is 110. But he has collected premiums. And he has got premiums of 100. Now he has bought the stock at 100, and he's receiving a premium of 1. Right? When you buy stocks, you are paying 100, and you receive 1 rupee premium, meaning the net cost of the share becomes 11. 99. 100 minus 1 is 99, and the maximum profit he will gain is 110 minus 99, which is 11 rupees. He will make a maximum profit of 11 rupees, not more than that. But in this case, his risk is not unlimited, because he already has shares. He has already purchased the share. So his risk is not unlimited. It's not a naked option, right? It is called a covered option. He has already covered his exposure, so it's covered. It's not naked. Then zero cost options. Right? That is where you buy a call option and you can sell a put option. Buy a call, sell a put. You are buying a call option which has a higher strike, and you sell the put option at a lower strike. You'll be long called short put. This will be the call option strike. This is the put option strike. In between, so this is the call option premium and the put option premium. This is the strike price of the call option, and here you get the strike price of the put option. So between the strike price of the call option and the strike price of the put option. Right? So if the market is between strike price of put and strike price of call, nothing happens. But the moment the market goes above the strike price of the call, your call option becomes in the money. And the moment it falls below the strike price of the put option becomes in the money. Right? So this is how the market will operate. And your net premium will be put option you receive minus call option you pay. By any chance, if the call option premium is equal to put option premium, you pay zero. That's called a zero cost collar. Right. So why you do this is to try and minimize the premium payments. It's called a cost collar. Right. So effectively, what happens is this is the market and time. This will be the call option strike. Here you have the put option strike. So for as long as the market remains between call and put, you are fine. But if it goes above, then you can exercise the call option. Again, if it goes below, you can the put option will be exercised. Okay, so that's options. Right. This is how the collar works. If the market goes above the call option strike, call options get exercised. Market falls below put option strike, put options get exercised. Right. So that is options. Do you have any questions? Okay, so if there are no questions, let's move on to the next area on derivatives. on futures. Right, so forward contract and futures contract. Now the difference is futures trade on an exchange. These are over-the-counter OTC contracts, whereas futures trade on an exchange. And so OTC means if you want to buy a loaf of bread, you can go to any shop you want, supermarket maybe, and buy loaf of bread. But if you want to buy John Keel shares or any share of a company, then you can't go to the supermarket. Now you have to go to the stock exchange. Right? So that's exchange traded. So forwards are over the counter, futures are exchange traded. Now the benefit of exchange traded is the features of being exchange traded is that the settlement is guaranteed by the exchange. Whereas over the counter, you're exposed to default risk. Default risk is there. Then the other features, forwards are obligations, whereas futures are also obligations. Forwards can be customized, futures are standardized. Forwards, there is no initial transaction cost. Futures you have to open. You have to open a margin account, right? That's where you deposit an initial deposit, which is called initial margin. So we'll come to that. And the other feature of exchange traded is that the buyer and seller do not meet. Question is, does futures contracts exist in Sri Lanka? But when you buy crude oil, we can use futures, cover the price. So crude oil is purchased through futures contracts. In fact, there is nothing that cannot be done with futures. There are weather futures also. You can have futures on the weather. Then there are pork belly futures, for example. You can have futures on commodities, such as pork belly even. You have sugar futures, soya meat futures, so many kinds. And there is a hugely liquid market. Right. So this is a little bit of information which you all can read when time permits. Now, futures trade in what is called a pit, a futures pit. If you watch Rogue Trader, Nick Leeson's story, you'll understand what a pit means. It's where all the transactions happen. Right? It's called a trading pit. Okay, this gives all the different kinds of futures. You have commodity futures like grain, oil. Under oil, you have different kinds: natural gas, gasoline, heating oils, crude oil. Then you can have interest rate futures, bond futures, notes, index futures like the Dow Jones, currency futures, metal futures, you name it, everything is there. So futures contract represents a zero-sum game between a buyer and a seller. Zero sum, that means like in options, the buyer's gain is the seller's loss, and the buyer's loss is the seller's gain. Likewise, and zero sum. Remember, markets are zero-sum games. You can't, two players cannot gain at the same time. Right? Now, for example, if you buy a share at 100 and the price goes to 150, you will gain. But what about the person who sold it to you? He sold it at 100, he loses, he has an opportunity loss of 50. It goes to 150. So if you add your gain and the opportunity loss of the other person, sum is zero. Right. So the futures exchange keeps track of gains and losses on a daily basis. So on a daily basis, your account is marked to market, called mark to market. Futures contracts are used for hedging and for speculation. Right. You can use for hedging as well as for speculation. Hedgers will shift the price risk to speculators. So if you don't want to take the risk, you can transfer it out to someone else using a derivative. So that person might decide to speculate on it. If you're speculating, then you're taking risk. Otherwise, you're hedging. Buying a futures contract is referred to as going long. Remember, long call option means buying. Each futures contract has an expiry date. Every day before expiry, a new futures price is established. If this new price is higher than the previous day's price, the holder of a long futures contract profits. Right? So if you buy and the price goes up, you will gain. If you sell and the price goes up, you will lose. But if you buy and the price goes down, you will gain. And if you sell and the price goes down, sorry, if you buy and the price goes down, you will lose. If you sell and the price goes down, you will gain. So it's just like buying a share. There's nothing new to learn. Let's try this example. You believe the price will go up. If you believe the price will go up, what should you do? Should you buy futures or should you sell futures? You should go long or short. If you feel the price is going up, you need to buy. That means you have to go long. So you go long 100 futures contracts that expires in 3 months. The futures price today is $400 per ounce. there are 100 ounces of gold in each futures contract. Okay, so this is how the futures will operate. Now, for example, if you buy, when you're buying crude oil trades in what are called lots. That is a standard size. That you can't buy 1 barrel of crude oil or 2 barrels, 25 barrels. You can't buy like that. You have to buy in terms of lots. A lot is 1,000 barrels. So you have to buy minimum 1,000 barrels. And if you want to buy more than that, you have to buy 2 lots. You can't buy 1.5 lots, right? So that's because it's standardized. Now, likewise, in this contract, it says there are 100 ounces of gold in each contract. Each contract has 100 ounces of gold. Like that, you're buying 100 contracts. So each contract has 100 ounces of gold. You're buying 100 contracts. Each ounce of gold is $400. The total spend will be $4 million, right? It's $4 million. Suppose your belief is correct and the price goes up to 420. So you bought at 400, the price goes to 420. You will obviously make a profit. Okay, so the price goes to 420, you bought at 400 into 100 times 100 is 20. You make a $200,000 gain. What would have happened if the gold price was 370? So if instead of going to 420, if the price goes to 370, then you will lose. You bought at 400, price is 370. You lose. You will end up with a loss of 300,000. Right, so this is going long. Then selling a futures contract, you go short. It's called going short for establishing a short position. Now you go short expecting the price to go down. And every day before expiry, the mark to market is done. If the price goes up, you will lose. Price goes down, you will gain. Let's try this example. You believe the price of gold will go down, then you need to go short, right? So you go short 100 futures contracts that expires in 3 months. The futures price today is $4 per ounce, 100 ounces in each contract, right? So the same thing, but this time you're going short. That means you are receiving dollars, 4 million. You will receive $4 million. Suppose your belief is correct and the price of gold is 370. Right. So you bought at 400, sorry, you sold at 400, the price was to 370. You make a gain. A gain of 400 minus 370. You get a $300,000 gain. right? And you will lose if the price goes up. So what if the price goes to 420? You lose $200,000. Yeah. So if you're hedging, then you're transferring price risk. Now let's do an example. Let's try this question. Suppose Starbucks, right? Starbucks is, as we all know, they're into the business of coffee, has an inventory of 950,000 pounds of coffee, right? So they have stocks of 950,000 pounds. Now the risk is the price going down. It's valued at 57 cents per pound. Currently valued at 57 cents. Now the value is 57 cents. So the balance sheet, they will record inventory at a cost of 57 cents. But if the price drops to 50, they will lose. Starbucks fears that the price of coffee will fall in the short run and wants to protect the value of its inventory. How can they do this? So what have they got to do? They have 950,000 pounds of coffee. £950,000 exposure into coffee. What can they do? Their risk is the price going down. So what they have to do is they have to find a derivative which makes money if the price goes down. So if the price goes down, for you to make money, you have to go short. What they have to do is they need to go short futures. Short futures. Okay, so it's further mentioned that there is coffee futures contract in New York Board of Trade. Each contract is 37,500 pounds of coffee. Right? 37,500 pounds per contract. So it's 900,000 total exposure divided by 37,500. Comes to coffee futures price with 3 months expiry is 58 cents per pound. This is 900,000. $25 contracts. So coffee. have 950,000 pounds. The plus at 58 cents. Sorry, 57 cents. Right, so that dollar position will be $541,500. They have bought coffee, so they are short of dollars. Coffee futures with 3 months expiry is going at 58 pounds. Now they need to go short futures. Right. Short futures, 25 contracts, net negative, 37,500 each. At 58 cents. The ink is not that great. So it comes to the short futures means they will receive dollars, 543,750 dollars they will receive. Right? So they sell 25 futures contracts. Right. So Starbucks has decided to sell 25 futures contracts. For the next month, the price of coffee falls. Right. So the next 1 month, after 1 month, what happens? In 1 month, coffee price has fallen to 51 cents. Now they will, to square off, they need to sell, they can sell coffee at a price of $484,500. And when they sell coffee, they will receive dollars. Futures price also has fallen, right? So their view was correct. That's why they went short. Price has fallen to 52 cents. Okay. So they need to buy back the 25 at 37,500 each into when they buy, they have to spend 487,500 minus. So if you take the net position of this, there will be plus 56,250 on futures, right? This is futures and the inventory. They will lose $57,000. On inventory, they're losing 57,000, but on the futures, they will gain 56,250. On inventory, they will lose 57,000. So the total, the net impact is the addition of the two, 57,000 minus 56,250. They will lose $750. That is the net. Now, if this was not there, futures were not there, Starbucks would have lost $57,000. But because of futures, they went short futures, they ended up losing only $750, right? So they have reduced their loss. Yeah. So the next question says, what happens if the price increased by 6 cents? So let's try that also. The price had gone up. This will be 63 cents. We go up to 63 cents. $57,000. Whereas futures will increase to 64. $56,250. That will be a loss. And so that will be $750 plus. Right. So if not for futures, they would have made 57,000 profit. But because of futures, they end up reducing the profit to $750 only. right? So if you're hedged, whether the market goes up or down, your profit impact will not change much. Your exposure will reduce if you're hedged. Right? Otherwise, if you're unhedged, your exposure will remain. Then you can make profits or losses. Right. So I hope that was clear. Let's try the next example on Nestle. Nestle is planning to purchase 750 metric tons of cocoa next month. They fear that the price of cocoa, which is $1,400 per ton, will increase before they acquire it, right? So they want to buy inventory, raw materials, cocoa of 750 metric tons. They want to buy it today. The cost right now is $1,400. So if it increases, they will lose. It's like you want to buy a car, but all of a sudden, if the price goes up, you will lose. So Nestle wants to fix the price it will pay for cocoa. How can they do this? Now they need, the risk is the price going up. So if that is the risk, they need to buy a derivative which makes money for them if the price go up, right? So what makes money if the price go up? You need to go long. How best to do this? There is a cocoa futures contract. Each contract is for 10 metric tons, meaning they have to cover 750 metric tons, 75 contracts. Cocoa futures, 3 months to expire is 1,440. Right. So let's look at cocoa. This is what they need. They need 750 metric tons, $1,400 per ton. Then on the futures, 75 contracts, each has 10 metric tons. They're currently trading at 1,440. Okay, so you're going long. Then your dollar position. This is the amount of money you have today. You will have 1,050,000. Right? That is the amount of cash that you have today. So the futures, you are going long. Meaning on dollars, you will go short. 1,080,000. Oh, the next month, the price of cocoa increases. So the price of cocoa has gone up to 2,409. Right. So there is an opportunity loss of $67,500. If we have to pay extra to buy the same amount of cocoa. Futures also has increased 1,525. In 1 month, it's 75 into 10 into 1,525. They can sell it at 1,525. With 75 countries they bought, they can sell. And they will receive $63,750. Right. So the net impact $67,500 minus plus $63,750. They will end up with a $3,750 loss. But if they hadn't hedged, if they haven't gone long futures, they would have lost $67,500. Now they are losing only $3,750, which is good. They saved quite a lot of money. Right. So futures are like a stock exchange. Only exchange members, only registered members are allowed to trade on the exchange. Exchange members may be firms or individuals trading for their own account, or they may be brokerage firms handling trades for customers. Now, when you open a futures account, when you open an account in a bank, right, you need to maintain a minimum deposit. Then to open a current account, you need to deposit a certain minimum balance. From bank to bank, it changes. If you have current account balance, you need to deposit an initial amount, and then they will say you need to maintain a certain minimum balance, right? So the initial deposit will be higher, and you can bring your balance down, but it has to be above a certain level. That's when you open accounts. A similar thing applies even for when you open futures accounts, margin accounts. You have to deposit initially what is called an initial margin. Right? And your futures account balance is being marked to market on a daily basis, but the balance cannot fall below maintenance margin. The minimum balance is called maintenance margin. Now, by any chance, if the account balance falls below maintenance, there will be what is called a margin call will be issued. They will issue a margin call, and you have to top up your balance. Right? You have to top it up all the way up to the initial margin. And the amount that you have to deposit is called the variation margin. That's how futures accounts work. Right, so let's try this Martin's example. Martin opens a trading account with ABC. He believes gold prices will increase. Right. So he opens an account at ABC, and he believes gold prices will go up. Now, if he feels gold prices will go up, what should he do? Should he go long or short? Answer is he needs to go long. There are 100 ounces of gold in a futures contract. ABC requires an initial margin of $1,000 per contract and requires a maintenance margin of $750. Right? So Martin has deposited $1,000 in his account. $1,000 initial margin, maintenance margin of $750. Right, so he has bought gold at $400 an ounce. $400 an ounce, right? He has deposited $1,000, initial margin 1,000 deposited, purchased $400 of gold. Right. Then on day one, the price of gold is $400. We bought at $400, no change. Day two, price is 398. So the profit will be, he will actually make a loss of $2. $2. Because he bought at 400, the price falls to 398. $2 per contract. Here there is 100 ounces of gold in each contract, isn't it? Yeah, 100 ounces of gold in each contract. So $2 into 100, you make a $200 loss. This day one balance is there. And day two, the account balance will drop. Day three comes down further to 394. Right. So day two it was 398. Day three it becomes 394. Value drops further. Right. Now this $200 is being taken off his account. It will be charged to his account. The loss will be charged to his account. That's why his balance is dropping. And another $400 will also be charged, right? So his account balance will drop from 800 to 400. So the moment it falls below the maintenance margin, this is initial margin, and this is the maintenance margin. The moment it falls below, a margin call will be issued. Right? Here, we will issue a margin call. This is day 3. And day 4, he's supposed to top up his balance. The next day itself, he needs to increase the balance to up to the initial margin, which means he has to deposit $600. So the variation margin is $600. He has to deposit $600. And then his account balance will increase to 1,000 again, initial margin. Next question. On 1st March, NDB is taking a long position in 10 May Treasury bond futures at a futures price of 105 per bond. One futures contract calls for the delivery of 1,000 bonds. Right. Thus, the initial futures price is 105,000. Okay, so the price of one bond is 105. They have bought 1,000 bonds. Futures price is 105,000. Initial margin requirement is set as 5% of the contract value. And the maintenance margin 75% of the initial margin. So it's 105. The price of a bond is 105. You have 1,000 bonds in each contract. Likewise, you are buying 10 contracts. So the initial margin will be 5% of the contract value. Which is 52,500. And maintenance margin is 75% of initial margin. So initial margin 52,500. 75% of that is 39,375. You need to deposit initial margin of 52,500. And maintenance margin $39,375. So on day one, the price has fallen to 104. On day 0, day 1, 104 minus 105. Okay, contracts each has $1,000. So $10,000 gets knocked off, and your account balance falls to 42,500. On day 1. Next week, 103. Which is another $10,000. Meaning it comes to 32,500. Sorry, 32,500 on day 2. So when it falls to 32,500, it's below maintenance margin. Therefore, a margin call will be issued. And you need to top up the balance. Top up the balance on day 3 up to initial margin. So you have to deposit total of $20,000, meaning your variation margin was $20,000. Right. So the next example. Long position of 5 July wheat contracts, each of which covers 5,000 bushels. Assume that contract price is $2 and that each contract requires an initial margin deposit of $150 and a maintenance margin of $100. Total initial margin required for 5 contracts is $750, right? Each contract has a 50 initial margin. You have 5 contracts, so it's $750. Maintenance margin is also 5 times 100, 500. Compute the margin balance for the position after a 2 cents decrease in price on day 1, 1 cent increase in price on day 2, and a 1 cent decrease in price on day 3. So what do you all think? Initial margin $750. Maintenance margin $500. So it was purchased at $2. Long position in 5 big contracts, each 5,000 bushels. Contract price $2. Each contract requires initial margin 150. So there is a 2 cents decrease in price on day 1. So 2 cents decrease in price on day 1. Each has 5,000 bushels. You're buying 5 contracts. So this $500 will get knocked off against your balance. So your balance on day 1 will fall from 750 minus 500 to $250. So it's below the maintenance margin. And margin call will be issued. So you need to top up the balance. Meaning you have to deposit another $500. 1 cent increase in price in day 2. So day 2, price goes up by 1 cent. $250. So $250 gets added to the account. Your balance goes up to $1,000 on day 2. 1 cent decrease in price on day 3. So day 3, the price comes down again to 750. Okay, so I hope that was clear. So let's move on to the next area. We'll skip swaps for now. We'll come back to that. And move on to forward rate agreements. Right? Forward rate agreements. The forward rate agreements are agreements where the customer might want to borrow, not today, but 1 year from today. It looks like this. Say, for example, you have a 2-year personal loan product going at, let's assume 12%. 2 years, you're lending at 12%. 1 year, let's assume you're lending let's say 1 year, 2 years, you're lending at 2%. 1 year, you're willing to lend at 10%. So a customer comes to you and wants to borrow for 1 year, for a period of 1 year, but not today. He wants to start it 1 year from today. He wants to borrow for this period, for a period of 1 year, starting 1 year from today. This is today, this is 1 year, this is the 2 years. He wants to start the borrowing 1 year from today, and he wants a 1 year loan. So if he comes to you and asks for a rate, what would you quote? So that is called a forward rate agreement. You're fixing the rate at this point where you're lending for 1 year, for a period of 1 year, starting 1 year from today. Now in this case, the bank should be indifferent between these two scenarios, right? Lending for 2 years or lending for 1 year and then lending again for another year after 1 year, right? Starting in 1 year. Right? Which means, let's say the amount is 100, so if you lend for 1 year, you will get interest of 1 plus 10%. Now the same amount, capital plus interest, if you are lending for another year, you will get interest of 1 plus R. For the bank to be indifferent, it should be equal to 1 plus what they get for 2 years, 12% square. So the 100 cancels off. 1 plus R will be equal to 1 plus 12% square divided by 1 plus 10%. Therefore, R is 1 plus 12% square divided by 1 plus 10% minus R. R is 14.04. Right, so if the customer agrees, he can borrow 1 year from today, 1 year from today at a rate of 14.04%. This will be his forward rate agreement. So in this case, the customer will benefit if he will come and do this if he expects interest rates to go up. Right? Now, 1 year from today, the interest rate is 20%. 1 year interest rate is 20%. Then the customer will benefit. But if it's 5%, he will lose. Right? So this arrangement is called a forward rate agreement. The customer in this case is long. And he is long the forward rate agreement, and the bank is short the forward rate agreement. And this is called, it is starting from today, starting 1 year from today, starts 1 year from today, and it goes up to 2 years from today. It's called a 1/2 FRA. 1/2 means it starts 1 year from today, and it ends 2 years from today. So 3/5 FRA means what? What does 3/5 FRA mean? When does it start? When does it end? 3/5 FRA starts 3 years from today, and it ends 5 years from today. Starts at 3 years, ends 5 years. This could even have been months. It have started on the 3rd month, ended on the 5th month. So it's effectively there for 2 months. Right? Now this is how you calculate the profit or the loss using this equation, which you need to memorize. So in this equation, there is a small mistake which you all need to correct. Payoff is equal to the market rate, right, minus the forward rate. Now, the contract rate. Divided by 1 plus market into day count. Let's fix the bracket. Now, if you look at this component, it is, see, the FRA starts 1 year from today and goes on for 2 years, right? So this was 10%. Here you had 14.04%. Now, 1 year from today, if the market rate is 20%, the market is 20% minus 14.04% divided by 1 plus market rate is 20%. So what effectively are you doing? Now, after 1 year, if the market is 20%, you will have 6% benefit. And so 6% benefit will come over a period of 1 year. And so actually, the 6% benefit comes at this point. But if you keep the deposit or the loan for 1 year, only you get the 6% benefit. And so your profit comes at this point, which you need to discount it back. So that's what you have divided by 1 plus 20%. That's how you get it. Right, so let's do this example. Dealer quotes a rate of 4% on this instrument. The dealer quotes a rate of 4% on this instrument, and the end user agrees. He is hoping that the rate will increase. Expires in 90 days. Notional amount is 5 million. The underlying interest rate is 180-day LIBOR. In 90 days, the 180-day LIBOR is 5%. Right. So he has agreed. The customer has agreed to borrow 4%, and LIBOR has increased to 5%. So the customer will end up borrowing at 4%. He has a 1% benefit, which he will enjoy after the period expires only. So let's draw the diagram. Expiry is in 3 months. And it's based on 180-day LIBOR. That means it continues for a period of 180 days from here, which is 9 months. So this is a 3 by 9 FRA. It starts 3 months from today and continues after 9 months from today, which is this is a 180 days period. Right. So the customer has agreed to borrow at 4%. Market is 5%. Right. So profit will be the market rate of 5%. Remember the equation, minus 4%. And this comes in a period of 180 days. Divided by the 1 plus the market rate of 5% into 180 over 360. So this is into the amount 5 million. you get 24,309 cents. So that's forward rate agreements. Right, so we will stop with this. Thank you very much, and we will meet next week. I will try and finish syllabus of next week. I will see you next week. Thank you very much. All the best. Have a safe week.